Hi, this is Ted Dhanik, CEO and Chairman of Engage BDR, EN1 on the ASX. Today we'll be answering some questions from shareholders and clearing up some potential confusion. Our goal has been to right-size and improve the business and the company's overall health. We've reduced expenses, raised capital specifically to generate revenue, and it's paying off. It's doing really well. April was probably our best month in many years from a revenue standpoint, an operating expense standpoint, and profitability as well. Margins consistent. They've been very strong also. The business has had legacy debt on its balance sheet for many years prior to its IPO. So if you take a look at the balance sheet on the prospectus, you'll be able to find a bunch of liabilities that were there since then, and it's consistent with what you saw on the December 31, 2018 annual report as well. A lot of it's been in dispute for ad fraud or invalid traffic, and we decided to deal with this in the beginning of this year, not only to deal with the balance sheet issues, but also deal with revenue, expenses, and other issues, financial issues at the same time. So we're trying to attack every aspect of the financials at the same time, not just the balance sheet, but also the revenue and expenses simultaneously. So the half-year mark, we're hoping to have a significantly better result, not just from a revenue and profitability standpoint, but also improved balance sheet. We've put it off for a long time as far as balance sheet improvement due to public market distractions. We've had a lot of stuff to deal with in the market. 2018 was a challenge for us, as you know. It was a lot of stuff we didn't expect. It was our first year. It was a bit inexperienced from that standpoint. Market was a little different than it is now as well. So now that we've had a little bit more experience, we've been fortunate to be able to take care of that, and we're very excited that improvement from all areas is expected for this half-year mark. Expenses, revenue, liability reduction, and the balance sheet position will improve significantly as well. The debts are being settled. Some of them are being settled for fractions of the initial amounts, and as we mentioned, there's ad fraud and invalid traffic and a variety of other issues related to contracts, and some of them are being paid entirely, and many of them are being written off completely, and some of these take a long time to deal with. So if we've been in dispute with them for a couple years and working with auditors, etc., we're able to mark off some every year as well. We're reserving the cash as it's very precious to us, for revenue generating activities, to activate publishers to generate incremental revenue. And it's been very great that we've been able to equitize and settle these debts. So from that standpoint, attacking the balance sheet at the same time using equity is helping us improve the position. And from our standpoint, we feel that it is very important to deal with everything at the same time. Deal with the balance sheet, deal with the expenses, and also grow revenue at the same time. And we're achieving great results in all fronts. As the single largest shareholder of the company, myself, and if you look at the top 20 list, you'll see me as First Round Capital. If you're wondering, why it's named that, it's owned by one of my entities. Nobody feels the effects of dilution more than I do. So all of us are being diluted, and myself as well. I'm not excited about that. However, it is improving the health of the company overall, and it's being done at market price. So any of these shares that are being issued for trade credit, you find that they are being issued at market price, the closing price of the day. There are no discounts there. So if you put it into contrast, if you do a raise, for example, any raises that we've done in the past, there have been a discount. Let's say there's a 25% discount, and that's unfortunate, but a lot of times that's what it ends up being. Plus a 6% broker fee, you end up losing 31%. It's a pretty steep discount, and that's for a raise. So why would we raise money at a huge discount, potentially 31%, to deal with these old liabilities? It doesn't make sense. We would rather do it at market price, and we've been able to equitize them using the script. And we're doing it incrementally. So we're not doing big raises at the same time. We're doing it at prices that are relevant to the market, a closing price for that day, and it's helped us quite a bit. It's helped us improve the balance sheet enormously. I've personally never seen a company go out of business for too much dilution. So never seen a company go out of business for too much dilution, but I've seen plenty companies go out of business for running out of cash. Okay, we are focused on balance sheet and receivables growth and reduction of debt, all of which ensure the strength of the company. So when you increase revenue, the receivables grow on the balance sheet, so you have a bigger asset. Profitability is improved. When you attack the expenses are reduced. That makes a pretty big impact overall, and then we're trying to do everything we can to improve it in all areas at the same time. Some questions from shareholders. I really appreciate you guys sending these messages. I get emails and tweets and stuff and text messages and WhatsApp calls and things like that from you guys like every day, and I really appreciate it, and it's always supportive. Nobody has told me to go kill myself this year, which is incredible, and that was happening a lot last year, so I'm happy. And I haven't done it yet, obviously I'm still here. So people have also expressed a lot of support for the stuff that I put on Twitter. Hey, it's my personal Twitter, and I think if you guys want to follow it, great. It's not the company's Twitter. So it's about me being a shareholder, expressing my interest in the company as well, just like you do on the forums and on Twitter as well. So it's not a company thing. It's me personally. My Twitter is at Ted Dhanik, twitter.com/TEDDHANIK, and you could follow or ignore whatever you'd like. Anyhow, so some questions from shareholders. Average revenue for Q1. So there's some confusion about that. People are taking, this is very, very important to understand. On the 4C, you have receipts. Now, receipts are collections, cash collected in that quarter. Cash collected in that quarter is never revenue. It is not revenue. It is nowhere near revenue. It is very different. So from that standpoint, we have some people taking the cash that we collected in Q1, dividing it by 90 or 91 days, coming up with an average revenue figure and saying that, hey, that's your average revenue figure. No, that's our average collection per day figure. It's very different than revenue. So the way you figure out revenue is we tell you what the average revenue is per day. So in Q1, the average revenue per day was about $15,000 per day. And when we said April had nearly 200% growth over Q1, we meant that April's revenue per day was nearly $30,000 per day on average. So that's what it was in April. So from that standpoint, that's about 200% last time I checked. So there's some confusion there. Confusion is cash flow versus accrued revenue. Now, all companies over a certain size report revenue on an accrual basis. I'm sure it's an IFRS thing, and specifically for publicly traded companies, you want to report revenue based on when you accrue it, not on cash collected. It's very, very different. This cash collected deal on the 4C is probably related to mining companies that had no revenue, how much money they're spending. Because there's no provision for revenue on the 4C, it doesn't say anywhere how much revenue you're expecting for a quarter or how much revenue you generated in that quarter as well. It's simply about cash in and cash out. That's just the explanation for it as well. So that is a little bit of clarity for you with regards to, hey, the average revenue in Q1 was about 15K and it was nearly about 30K in the first month of April. So that is about 200% average increase. And we will report May and June as well. And then we'll give you a figure for all 3 months and compare it to Q1, because Q1 is supposed to be the slowest quarter of the year. And so is Q2. Q2 generally about the same, but we've got a pretty strong increase over Q1 already, which is a very strong indicator for the year. So from a seasonality standpoint, everyone's asking about seasonality. What do you expect from a seasonality perspective for the year? You expect 65 to 75% of your revenue in advertising to come from the later half of the year. So Q3 and Q4 are responsible for the heavy lifting. Now Q4 is the heaviest quarter of the year. It's the biggest, and the majority of revenue for the year will come from Q4. That's typically how it's been, and we have 11 years of data to prove that. This is not a guess, and you can look at other companies in this space as well. So Q1 and Q2 are the slowest quarters of the year. Those are the flat quarters that kind of stay the way they are. They're great. We live in them. We have I believe we're having a great Q2, so we're very excited about it. But Q3 and Q4 are the quarters of the year where you're the most excited, and that's where the companies usually turn a profit, and that's where they end up having the best results overall. Q4 is the biggest quarter of the year, hands down, and we're looking forward to having a very strong Q4. Now, what happened to us last year was we didn't have enough capital to service from moving past Q2. We did an acquisition in about Q2. We raised some money, only half of it came in, and then the rest is history. We weren't able to raise any more money for the balance of the year, and that caused us a cash crunch, and we weren't able to deploy cash for publishers, and that's why we weren't able to hit our goals last year. However, this year's very different. So if you look at the 4C, you'll see that we have about $13 million in accessible cash available to us through our facilities. So we have cash this year to make things happen. If we had this ability last year, this capability of accessing this type of capital, we wouldn't be having this conversation today, right now. This video wouldn't exist. But we're a year behind, but it's never too late, right? So we're expecting this year to be explosive for us. Another question from a shareholder was with regards to legacy debt settled for balance sheet improvement. Another question with regards to that. Constant settlement for write-offs of fraud and disputed invoices. Some settled for less, some written off completely, some paid in full. So essentially we're trying to just get it all off the balance sheet, and in the essence of time, we may just elect to sell them for what we can to get them off the balance sheet, and we're equitizing them. And essentially that's kind of an ongoing thing. Will we slow down? Absolutely. We don't think the share price currently is where it should be based on how we feel about valuations of our company compared to others. So from that standpoint, yes, we will probably reduce the volume of issued shares for to equitize debt moving forward for some time now. So that's essentially what it was. If you look at the video in the beginning, we talked a little bit more about this area, so that can answer some more questions. Talk a little bit more about it in a bit as well. Balance sheet improvement has been significant to date this year so far, without giving you a number, and I can't really give you a number, and the reason, well, let me tell you why. You'll find some language in the bottom of our announcements that talks about subject to audit and figures or estimates and averages and things like that. And there's a reason for that. It's not because we're trying to be evasive or because it's what some people call fluffy. It's none of that. What it is specifically is, hey, I just don't have figures, and auditors are auditors, and at the end of the term when they do the audit, we have a lot of surprises. The surprises are generally in the area of amortization, depreciation, intangible asset impairment, things like that. So we're a company that capitalizes software, as most tech companies do, and the accounting firms or the auditors generally decide how much depreciation or amortization of that and other intangible assets they'd like to hit us with at the end of the period. So it's hard to say what a balance sheet will look like specifically. It's also hard to say what net income will look like, because, by the way, net income includes depreciation, amortization, and other intangible asset impairments as well. So net income and EBITDA will always be different. So generally, we like to give you an EBITDA number, as EBITDA does not include those non-cash items, and there may be an add back as well for asset impairment. EBITDA generally includes an asset impairment. We like to add that back because it's also non-cash. So balance sheet improvement, back to that, has been very significant for this year so far to date. So I'll give you some of the numbers, and you can do the math and see, what you think with regards to what the improvement looks like. As I mentioned, I can't add those numbers up for you because we don't know what the intangible asset impairment, depreciation, and amortization will end up being. So take all the drawdowns from the facility this year, capital raised in January. So it's total about $3 million Australian. So between the drawdowns and the capital we raised, and the trade credit shares issued, total about 2.9 million or so dollars Australian, less any converted debt, because the debt that was converted, anything that was on the balance sheet that was sitting as a convertible note and has been converted, also comes off. So I would say about $1 million or so, about 800,000 to $1 million or so of that convertible notes have been converted out, and so they're not on the balance sheet anymore. And it gives you an approximate picture of how much the balance sheet has improved to date since December 31. So about $3 million raised, $2.8 million or so deployed in shares to reduce trade credit. In addition to that, another $1 million or so reduced in liabilities from conversion of the convertible notes that moved off as well. So it's a very significant improvement in balance sheet, which we're targeting for the half-year mark, and we're excited to report. Additionally, this is really important, all the cash that we have raised so far has been deployed to activate publishers. That's what it's been for. And when revenue increases from these new publishers, accounts receivables also increases in the balance sheet. That further improves balance sheet position. So you have a net increase in assets because of the increase in revenue. So that receivable number grows as well. So we're really trying to hit this from all sides and all angles and trying to improve the balance sheet significantly. So we're very excited to say that, hey, we're going to have a much better balance sheet by the half-year mark. We're going to have better financials, better revenue, better profitability, etc. All of this is we're trying to do everything at the same time. Essentially, that's what it is.